Please welcome Salome Paralava, Consult Hyperion, Jeffrey Billingham, Market, Jennifer Peavy, DTCC, Greg Schvey, Exani, and David Harris, Post-Trade Distributed Ledger Group.
Thanks everyone for coming. Today we have quite a challenging topic to discuss, but I think it's going to be a very interesting conversation. And we'll start with introductions. Each of the panelists is involved in different distributed ledger technology initiatives, and I would like them to talk a little bit about themselves and what they do in this space. Jeremy, let's start with you.
Sure. Jeff Billingham, Vice President at Market. I work in Market's processing division, which houses all of the financial industry's post-trade, OTC, and loans architecture, and leading the blockchain initiatives firm-wide, so a lot focused on smart contracts, obviously in the processing space, but also very interested in reference data, KYC, and looking forward to working with the industry and bringing some semblance of scalability to blockchain solutions for us.
My name is David Harris. I'm speaking on behalf of something called the Post-Trade Distributed Ledger Group, PTDL. We are a group of 37 plus banks, custodians, exchanges, clearinghouses, settlement houses, regulators, and central banks. We started to organize ourselves probably in the fall as we saw that the distributed ledger technology has great application in the post-trade space, and basically we're plumbers. And so the group is looking at the issues, everything from how are we going to make more efficient and sound and secure the post-trade space, to the regulatory issues that are certainly going to come up as we experiment with blockchain, to how are we going to interface with the regulatory bodies that are global. Our members are all global, so it's a very kind of dynamic group.
I'm Jennifer Peavy. I'm with DTCC's Strategy and Business Development Group. I'm leading the efforts around our Office of Blockchain, which is coordinating and managing all of the blockchain activities across both securities and derivatives. As part of an industry utility, our responsibility is helping the industry to innovate and bring this technology to market in a way that it provides the safety and reliability, resiliency that we have today.
Greg Schvey. I'm the CEO and co-founder of Exani. Exani is a distributed ledger infrastructure technology company, so we work with large financial institutions, a few of the firms that are up here on the stage today, and we've basically been focusing on a few of the key areas which we'll get into around transparency and the various other implementations of the technology related to particularly post-trade infrastructure. Exani was actually spun out of a company called TradeBlock, which is about 3.5 years old, which I was also the co-founder of, that is the world's leading provider of institutional Bitcoin trading tools.
Thank you. Before we jump in, I wanted to remind you that you can ask questions on the Slido app, and please do. So I find it fascinating that the technology that originally was intended to disintermediate now is looked at as a technology that can help in many other use cases by huge financial players and intermediaries, in essence. So my question is it a keep your friends close, your enemies closer situation, or do you see genuine benefits, and if so, then what are those in immediate, like what are immediate benefits that you see, and what are the long-term benefits? So I think, David, could we start with you?
I shouldn't have been so cocky back in the press room saying I could handle any question. What we see is, at least our group, is an evolutionary process where we have to responsibly assess the technology, and determine ways to make the infrastructure better. As part of that process, and I think we'll talk about this later, there are a lot of regulatory things that the technology provides, right?
Yes.
Which are fantastic. Some simple ones are just the fact that we have multiple ledgers that are resilient, right? And I think resilient in terms of operation, because if you're running anything, an exchange to a clearinghouse to a large custodian, you're always worried about your ability to be resilient. Transparency is something that I think is kind of key to what we'll be talking about a little bit later. And then I feel like the big thing that I'm most excited about is the ability to have the regulators a little bit more involved in understanding what's going on in the markets, right? Rather than playing catch up, I think that there's an opportunity here for them to actually be a participant in understanding the information as the information is being developed.
Thank you.
And actually, so I feel like oddly qualified to actually handle this question because TradeBlock, the company that Axani was spun out of, sees the vast majority of institutional trade flow in Bitcoin executed through our platform. So we stay very close to that market historically. And I think what we have to recognize in terms of the difference in terms of the capital markets implementations is that Bitcoin is specifically meant for a very particular use case, right? Which is how do I come to an agreement on what tokens have been passed around in this global open network, right? And if that's the extent of the use case, it's great for exactly that. But the underlying technology does things like have easily synchronizable data structures. Data is recognized in a different way. The messaging protocols can be translated into these private and permission chains. So if you decompose it into its relevant Bitcoin, into its relevant parts, you can actually abstract a lot of it out and apply it in these capital market scenarios quite relevantly as well.
So if I understand correctly, what you're saying is that you can actually improve some of the functions of the financial markets. Then the related question would be, if you could improve some of the functions, is this the best technology you could do this with?
Right. I mean, so what ended up happening, right? You've got very old legacy systems. A lot of them are joined together from, you have these composite systems that have been built up over many acquisitions in a lot of these banks, right? And so what you have is a system where counterparties can't even agree on what their trade is. Meanwhile, you've got a guy in San Francisco who can reliably send money to a drug dealer in Sweden, and that transaction works out and matches, right? So people are looking at this saying, how are they possibly able to do it? And capital markets aren't able to figure it out. Well, let's apply the same technology and see if it works.
I think that there's a lot of the core elements of the technology itself, the distributed data storage, the mutualization of infrastructure, the added security and the transparency that comes with it, all really key benefits to leveraging the technology to help reduce cost and increase efficiency within the post-trade processing space. That being said, as you mentioned, is it the right technology for a particular business use case and or challenge? And that's something that the industry is really focused on right now and understanding through detailed cost-benefit analysis, looking at not only the internal cost-benefit analysis, but also across a network of market participants, what it means for the community as a whole to implement a business process on the technology, and really understanding, is it the right fit, or is exploring existing fintechs such as cloud technology a better way forward?
I think that speaks to your prior question, right? It's really much more about not so much disruption per se, but normalization, I think. I think every participant you see in this space right now has a part to play in a blockchain world. But if we can achieve some degree of shared ledger, or if we're all sharing some sort of ledger, all of the sort of the bells and whistles that exist around some of the fundamental marketplace that something like a clearinghouse offers, right? That might be a little bit, those might exist in a bit of a more competitive space, right? Blockchains don't necessarily, they're not going to eliminate clearing, but those sort of services that exist just by way of a clearinghouse having access to central books and records might exist in a much more competitive space.
Yeah, that's an important point, and we'll come to gross and netting later. So what I wanted to talk about now a little bit is that, so you mentioned that we can reduce costs and increase efficiencies. But there is another characteristics of the technology, such as transparency, which is sometimes underlooked and is mentioned of something as a secondary importance. So let's look at it from another perspective. So people say that blockchain is a solution looking for a problem, right? So could opacity of financial markets be actually that problem that blockchain could solve in this particular financial market space? So Jennifer, I think that's a question for you, first of all.
So I think the way that we look at the distributed ledger technology and the implementation of that technology, as I mentioned, is really understanding how it benefits the market as a whole, right? Ensuring that with the added transparency that we are working with regulators and policymakers to ensure compliance of the technology and the use of the technology with respect to existing regulations and laws, particularly related to data privacy, security, confidentiality. Those are some big ticket items that I think still need to be worked through. Ensuring that the distributed ledger technology for an implementation is done so in a way that it meets and complies with existing regulations and requirements, and where it doesn't, highlighting those gaps and working with the regulators and policymakers to identify and propose appropriate solutions to move it forward.
Yeah, just a quick anecdote on this one. So recently announced was a completion of a credit default swap trial that was done on the blockchain with, of course, DTC market, ourselves, and 4 of the largest banks in the world, right? And so one of the things that was actually proven in that is that you can have validated data visible to the regulators in real time, queryable at scale in milliseconds, right? And you can get all the way down to the details of every single trade. Actually, frankly, if you wanted to, you could get down to the functions that were behind the actual processing of it if you wanted to. Right now, that level of transparency is something that is most closely achieved, incidentally, by the trade information warehouse in a lot of spaces, right? So the trade information warehouse currently, the DTCC's basically credit derivative processing mechanism, actually functions as what's known as a gold record of a trade, right? So what we did is prove that you can have a distributed version of a gold record. Most other similar markets don't really have a concept of a gold record, right? So if you can create that gold record in this distributed fashion without having to set up some giant industry body or organization, or if you can actually have something where you say, okay, we're on this network, let's start using this as a gold record for many versions of trades, you can now have provable truth that can be translated out to regulatory bodies as well, right? So the discrepancies fall away, as does the provable regulatory reporting that happens effectively instantly.
But what prevents, for example, DTCC from having that record, but without distributed ledger technology?
So yeah, great question. So they do, right now, they actually have the gold record currently in the trade information warehouse for credit derivatives. A couple things about that. One, the end users then have to continually reconcile against it, right? So there's an agreement in place that says, yeah, this is a legal construct that we agree that this is the formal legal version of the trade. To set that up took an immense amount of industry effort. It takes infrastructure being run by the DTCC, and it takes the constant upgrading and modifications of that to kind of go through that same sort of process, right? So it exists again in credit derivatives, but that same initiative hasn't really ever been achieved in most other similar markets.
So it's not just transparency; it's a data transparency which is in machine-readable format, so you can actually automate some of the regulatory enforcements. Is this so?
Yeah, absolutely. And it's also, I mean, the other thing too is, misreporting is also an issue in a lot of times, right? So the end users are, the counterparties are responsible for reporting requirements, and there's a couple things that come out of that. One, mistakes get made. Here you have a technology where you can actually give regulators visibility into the actual data object itself, provable that their record matches the actual golden version of the trade. And two, particularly in things like credit default swaps or other swap markets, you have these third-party repositories that are responsible for actually taking in the data that's required for regulatory reporting. Now those are disparate, and you actually, as a regulator, you might have to go to multiple of those. In the United States, it's a little more consolidated than in Europe, but ultimately that data is kind of scattered all over the place right now, right? And it takes that extra push process, right? So it's both consolidated, transparent, and automatic.
And as you mentioned, it's the audibility of the data too, right? The transparency and audibility to verify the assets that are there for transfer, verify the ownership, and as Greg mentioned, being able to really drill down on a transaction by transaction basis to see that auditable history of the transactions. That was the level of transparency that in the proof of concept we were able to demonstrate.
And I think this put really legs on the smart contract terminology, right? At least for us. As Greg said, everyone was looking at the same data object, right? That's what really made it clear to us that in some way you can actually sort of commoditize reporting, right? I'm not going to and from my counterparty. I'm not going to and from DTCC. We're all, my counterparty and myself, we're looking at the actual same data object that is our trade.
Yeah. So I know that Jennifer mentioned this, but I wanted to ask David what are your thoughts on this particular thing. So do you think it's the case where distributed ledger technology could help us to comply with the existing regulations? Or is it the case where distributed ledger technology actually creates new realities for which we need to have new regulatory frameworks?
The answer is probably both, right? So as you guys were just talking, right, the distributed ledgers will certainly help with some of the issues around record keeping and the accuracy of records, right? Everybody, not only do you have an obligation to maintain records, you have an obligation to maintain accurate records. So there was obviously a lot of cases that come out of the government when your records differ from other records and and that's your fault, right? So to have a distributed ledger of which the government may be running a copy also, will really change how record keeping is maintained. The flip side, and I'm kind of making this up a little bit, is that some of the questions that we're going to have to start asking ourselves is, when I start giving ledgers to multiple regulators in different jurisdictions, what sort of what am I opening myself up to, right? So if I give a distributed ledger to a regulator in Luxembourg, for example, but I don't do business in Luxembourg, I have no presence in Luxembourg, yet they're running a distributed ledger, they have my records on it, right? Is there an argument now that I'm subject to their regulatory regime? So there's going to be a whole host of issues that we're going to need to sort through. That's a simple one that just kind of popped into my mind. I think as we really focus on what we're doing, we're going to find that there's some very long-held beliefs that are going to be challenged by distributed ledgers. It's going to take a lot of work and a lot of industry thought and a lot of cooperation among all of the parties, regulators included, to kind of sort through those issues.
So as I understand, so post-trade distributed ledger group, so this is one of the focuses of post-trade distributed ledger group, right?
That's right. So as a group, the members and others, including the regulators, will bring to us, information, right? As we're looking at distributed ledgers this way, or we're considering a use case like this, and our regulators have given us feedback that looks like this. So put it in a single place, because ultimately, the power of a distributed ledger is the distribution of the ledger. And so to be able to start to harmonize how regulators consider what we're doing is going to be key, and I feel that that's one of the key objectives of the PTDL.
I would add to that also that there's, if you think about the ease and automation of record keeping and asset transfer, it actually opens up a lot of opportunities for new sorts of products and opportunities that have never really been possible. So just as an example, one of the things I think about as kind of 10 years out is, right now, if you if you get a mortgage, your bank's probably selling it out to a servicing agent. They package that up, and then these big groups of mortgages kind of get moved around as CMBS or other similar products, right? Now, that intermediary step and that packaging is required because there's a trail of records that literally exist within boxes in these various different offices. It's conceivable that we get to the point where a CMBS is a dynamically created portfolio. You can swap out individual mortgages or chunks of mortgages ad hoc, right? Mm-hmm. Now that level of flexibility is possible with something like blockchain tech, where you have synchronous records between many parties. You can actually transfer assets at that level. But it's very different because, from a regulatory perspective, it's how do you regulate that where all of a sudden, maybe the mortgage is being held by, the fourth party down the line, and like how do the payments actually get there? And there's all sorts of other obligations that have been and regulatory frameworks that have been built specifically for servicing agents, for example, right? So what happens when they get disintermediated and I'm now passing mortgages around freely, right? I mean, there's just a ton of things that are almost even unforeseeable that will undoubtedly have to get addressed.
Yeah, and it's funny because I had this great conversation with my technology guys, right? Because they're doing what they're doing. But some of the concepts that we're going to be challenging are concepts that date back to Roman law, right? I mean, kind of a question that I haven't kind of been able to get my brain around is once I digitize an asset and put it on a distributed ledger, where physically is that asset, right? In the old days, possession's 9/10 of the law, but now I've got it distributed, across the globe. So where is it?
So do you think there are particular asset types for which distributed ledger technology is more suitable and more beneficial? Jeffrey, maybe you can start with this.
Yeah, sure. We have for a long time made the distinction between digitizing contracts and agreements versus digitizing assets, and I think the asset conversation is a really, really fun one. So many people say, I have digital money. Why bother with a blockchain? And I typically respond, you have electronic money, right? You have an electronic record from your bank of the money that is owed to you, right? So there are a number of different sort of electronic records, books and records, of what you actually own. Whereas I think the digital asset conversation is very interesting because that means it's akin to Bitcoin, that I can actually own the asset unto myself, wholly unaccounted for. I think in the financial services space, you can definitely look to, how could we potentially digitize cash or some cash instrument? How can we have some sort of explicit representation of credit? How can we sort of, digitize credit or credit instruments? How can we digitize securities? I think those sort of three things cover what we typically obligate inside contracts.
So do you think maybe smart contracts technology, which provides automation, so it could provide like standards and encoding of complex contracts, could benefit for unstructured complex assets rather than some easy, simple assets that are on financial markets today?
Yeah, certainly. I think, the promise is if you can digitize a contract and you can digitize the actual assets that you obligate in that contract, you can sort of see some semblance. I could say I might be able to minimize the cost incurred to me to maintain those assets and transact those assets, right? Mm-hmm. So I think that ultimately it is a cost play that allows you to have a little bit more flexibility ultimately over your balance sheet.
Okay. So my next question would be around CCPs, central counterparties, and it's an easy question. So could CCPs and blockchain coexist? So clearing uses CCPs for netting, and the question is, so do we actually need netting with distributed ledger technology? And if we don't, then do we need CCPs? So maybe Jennifer, we'll start with you.
Sure. So, I think we've had a number of discussions with the industry, and there's actually been, I think, several reports and articles written that, the industry is looking at the using distributed ledger technology on a permission basis. And as such, the role for a trusted, regulated third party, such as DTCC or other CSDs, exchanges, there is a role for them with distributed ledger technology or blockchain technology. The use of this technology can be done in a couple different ways. There's a role for the technology with respect to plugging into large, complex infrastructures to add new services. So in that respect, obviously, a CCP or CSD would have the ability to expand their products and services, leveraging the technology by integrating it to existing infrastructure. On the other hand, there's a role for these organizations and to provide governance and administration of the networks, right? So, today we have, a DTCC as utility operates TIW and other services for the industry, and we have sets of rules and governance on those activities. We see that role would be very similar with blockchain networks, providing the permissions, the roles, responsibilities, the behaviors of who participates on the network, working with the industry to set the guidelines and the implementation structure around smart contracts and others like oracles who might connect to the network, understanding the regulatory complexities and providing the bridge with leveraging our regulatory relationships to provide the confidence that the network that is being used is compliant with existing regulations and laws, and also providing continuity across legacy infrastructure and new infrastructure like blockchain technologies for any legacy assets. Those are roles that organizations such as DTCC could certainly play. There's also, I was asked a question yesterday, what about, today there's usually one person, one organization that's responsible for, the resiliency, ensuring the resiliency and the security, safety of that network. And, I think that while that still needs to be discussed amongst the industry, that could also be a place for an organization such as DTCC to play a role.
And I think one of the supporting evidences for argument about governance that DTCC could provide is what's happening with the Bitcoin's external governments and all the debates about block size and all other things. Well, if we go in a little bit into detail, I would like to ask, I think, Greg about the particular architectural choices you make in your implementation of the blockchain.
Sure. Yeah. So I think one of the big choices that has to get made in any sort of blockchain or distributed ledger structure right now is whether or not to have a logic layer that's baked in as well. So if you look at something, the most public examples of this, if you look at something like Bitcoin, where it basically has set a preset list of functions, and it has a very secure and trustable data layer, but to do other things on top of it requires external sort of systems or whatever else it might be to read it. The second would be to actually integrate natively that logic layer actually into the same distributed ledger technology. That would be something more like Ethereum. We've actually implemented on both. The Ethereum-like model has been more interesting for us of late. It provides a lot more flexibility going forward, and requires a lot less to be pre-programmed. There's debates on both sides of this. And then, there's a series of things that are, for the time being, proprietary and just shared with, half the panelists up here already know what they are because we've done projects with them. But there are a variety, when you actually look at the actual decisions on this, the non-functionals are going to be clear across any implementation. Does it have resiliency, throughput requirements, and scalability? Does it have privacy secure? Does it have appropriate transparency, right? And so when we look at things that we did in the CDS project, or we actually did a similar project with Triana, it's an ICAP company on FX post-trade, and we actually tested these things at scale, right? So we tested the CDS example, we tested this up to the entire active volume of the trade information warehouse today, ran a month of data through there in 8 minutes, right? These are the kind of things you have to be able to test these production systems through at scale. For the FX project we did with ICAP, we ran FX volume through this, right? So as you increase the level of complexity at the core architecture layer, you have to be able to say, how do all of these various components end up balancing out? And there are, there's always going to be sacrifices and balances to be made.
Just for the interest, so is everyone on the panel is pro-private blockchain, or there's someone sympathizes open blockchains? Jeffrey, I think maybe you?
Yeah,
no?
I think that the public versus private debate, ultimately, everyone's trying to answer, how do you authenticate the people who are a part of a network, and how do you authenticate the items that they're actually transacting? So frankly, I think it's a bit of a false question. I think there's, I think a lot of it hinges on interoperability of different blockchains. And certainly, we should definitely work towards trying to figure out how can we authenticate folks to interact in a fully natively digital space.
I see.
But also, I'm going to throw into this also is that public blockchains and private blockchains achieve different objectives, right? So the idea of having something that's open and global and accessible to anyone, and that it achieves, Bitcoin achieves things that are different and unique and incredible, and I would actually argue miraculous in the way that it balances technology and economics. But it does that because of the fact that it requires it to be open to everybody, right? So that it achieves things for that purpose that just don't need to be achieved in a private permission version where you have, an easily reconcilable data structure that can happen natively with a protocol for communication and that reconciliation process. It can be done in a private way that doesn't require economic incentives to operate the network, for example, right? It seems like there's over the last year been a false dichotomy created about which one's better, or which it's just you got to choose what you're trying to do, and both of them are very, very powerful for their respective use cases.
Before we jump into questions from the audience, there is one more question that comes from London. So there is Robert Sams, who couldn't unfortunately join the panel. He's told me that he wanted to challenge the premise of the title, which is preventing the next Lehman Brothers. And his thought was that, well, we shouldn't be preventing next Lehman Brothers. We should be providing resilience to the system to avoid an inevitable, actually resilience to the system, because some failures are inevitable and healthy. So what do you think about that? How do you respond to the challenge from the panelists that couldn't make it?
So preventing Lehman Brothers is a huge topic, right? I mean,
Yeah,
so there is certainly the transparency components. This is something that's been even following up on the CFTC, or excuse me, following up on the CDS announcement. The commissioner of the CFTC made the statement that had this technology been available in 2008, things would have been a lot easier for them because there would have been more transparency, and there would have been 3 weeks of phone calls trying to figure out who was exposed to who, right? Now that's one very small component of what preventing Lehman Brothers means. So Lehman Brothers was everything that led up to it, which is the capital requirements to take on these types of positions, the risk metrics and the reporting and capital ratios that are now required for banks. So there's a whole pre-component, and then there's the post-component and the fallout and the way that those decisions were made. So if we're talking about transparency and operational efficiency, yeah, it's definitely there. To some extent, there's definitely a capital efficiency play with blockchain, but there's a lot of stuff that happened around Lehman Brothers that's probably, we could have a whole conference on that if we wanted to. Yeah.
Someone else want to jump in? Okay, I'll go to the questions from the audience.
Thanks for being so quick.
In case of hypothetical collapse of a financial blockchain holding billions in distributed assets, who would be liable? The asset holders? Who wants to start? Jeffrey?
I certainly imagine that there will not be one blockchain for the entire industry. I think you will certainly have blockchains or peer-to-peer networks that securitize and transact agreements like we had in the proof of concept with Axani. You'll have, maybe, who knows, maybe companies will create some sort of network to drive, securities and ownership of their securities. So I think the question really lies in how will those interoperate, as opposed to imagining one massive blockchain with a kitchen sink, and who's responsible for what when that thing falls down.
Well, even if there are many blockchains that interoperate, doesn't it make it even more complex for liability models?
Potentially, I think that the opportunity here is certainly around that transparency and regulation and reporting, right? How can we ensure that those who are responsible for maintaining an eye over the markets are able to enter into and see at a bird's eye level in real time exactly what they need to see and when?
There's also, I'd also point out that distributed networks are inherently created to be resilient. The Bitcoin blockchain has been operating for 7 years. I don't think any financial institution has a system that can say that. Right? I mean, it's just the nature of distributed systems, and that's the intention. The second is that the concept of distributed ledger, right? You have this immutable, always moving forward record of what's happened. So even if let's just say the global internet goes out and there's no more connectivity to your counterparties, you always have a record with cryptographic signatures that prove that actions were taken up to the point that it stopped. Right now, that doesn't change no matter if the network falls down. You always have that record, and you always have the cryptographic proof that it's valid. Right. So not only is it resilient, but the backup processes on this are fairly straighthtforward.
Jennifer,
I'll be a little different on this one. So I think it's a question that's got to get put onto the pile, right? Because we have a once in a lifetime, frankly, generational opportunity to do something right from the beginning, right? And so to ask the question, what happens if actually everything goes off? Right? That is a question that frankly should be asked, because we need an answer for that.
Yes, I agree with you.
Right.
And
Yeah,
Jennifer,
I think just to build upon that, I think there's a number of things. Last year, I think a lot of the industry was really interested in the functional aspects of this technology, right? Show me how this works. Proof of concepts to really demonstrate that functionally it can do what it says it can do for the wholesale financial markets. Now, I think answering a lot of those edge case questions is really in the forefront of the minds of many within the industry, right? Understanding the regulatory and legal risks, understanding the cost-benefit analysis we mentioned earlier, understanding what competing priorities there might be within each individual organization and the implementation of any distributed ledger technology, looking at the tools that are needed to really maximize the benefits out of the distributed ledger technology and developing those tools. So there's a whole host of non-functional, questions that still remain that I think many in the industry are really focused on. DTCC is working with the industry as well to help identify, and bring answers to the table with respect to some of these questions so that we know how we can progress the technology.
I think we have time for one more question from the audience, and here it is. So the Community Reinvestment Act was intended to increase access to credit to low income and minorities. How might such regulation apply to blockchain?
I think I understand where they're getting at with that. So I think,
I don't.
I'm going to take a leap. I think.
But it has two votes, so.
Yeah. I think one of the somebody has a friend sitting next to them is what I'm. So I think one of the points of this is that that act was intended to give people access to the financial system in a way that is supposed to better their lives and everything. And in the context of Lehman Brothers and the way that mortgages were packaged up and bet on, whether that's good or bad is I'm not even trying to qualify that right now. But I think one of the, in terms of the blockchain component, I think one of the pieces of that is, can you give people more direct access to financial markets using this technology, right? So if that was more around lending practices, this is more around, do I have to go through an expensive brokerage service to be able to access this network, or is this something that I can actually, have some sort of direct connectivity to what's going on and actually reduce those fees and say, I don't need to buy $10 million worth of some product to get a good rate on it. Maybe we can actually have an open and easily transferable market where we can say, I plug in with this technology and now I have access to it in that way.
Thank you.
That's my best shot at that one, yeah.
And very quick last question before we go is how long would you think it will take before some live implementations of any use cases in financial market will go? So just for every panel.
Sure. I mean, I think you'll see POC move to pilot towards the end of the year, so other participants will be able to participate in these proof of concepts. I would say 3 to 5 years out, we'll see some semblance of this in the post-trade space, and then 5 to 10, it's sort of sky's the limit, I think.
Okay. David?
To be non-controversial, I'll totally agree.
I'd say, with the de minimis number of market participants on a distributed ledger network, 3 to 4 years-ish is probably reasonable. Anything more than that is going to be a much longer tail.
I'm pretty ambitious on this stuff. I also, I have the benefit of being very close to the technology and the way it's being developed, and every week we see improvements. So I'd probably be more towards Jeff's initial answers of I think I wouldn't be surprised that if within 2017 we saw strong production versions of this.
Thank you for all panelists for an interesting conversation, and thank the audience.
Thank you.